Hi, everybody. I hope you've all signed up for the Trader Summit, which is on your screen. Starts Friday. Limited seating. Hope everyone's doing okay.
Morning, Dale.
There's my buddy Ryan.
How's it going?
Pretty good. So let's share this and take a look at this. Nice instincts, trader intuition on Euro from last week, Ryan. You said it just didn't feel right, the rally.
Yeah.
Can you see it?
Just didn't feel right at all, did it? Now we're all the way back down again.
Yeah. So I don't like that it's back under 1020. Do you think we're going for new lows here?
Yeah, it's possible. I'm a small scalp long on the big figure, but if it breaks, I might fold it. It's not looking, as I say, not looking hot at all, is it? It's done nothing but drop since we made those highs up near 112.
Yeah, and I don't like that it's weaker than cable, EG as well, pulling back. So, yeah, maybe this was just an ABC and we're going again. So, yen, it's trying to recover after the initial bounce, but at the same time, yields are kind of looking like they're putting in some type of potential little head and shoulders pattern. Is that possible there?
Yeah,
that line at 228.
You so probably overlay those charts, the dollar yen and the 10 years at the moment. Walking hand in hand, but it looks like the end of month put a little bottom in the retrace of dollar yen down towards that 121 handle. So we've got a definitive low now. I wanted to see some multi-day support and resistance, mainly resistance coming in, but we've got the support there into 121, low 121s. Let's see what we do on the upside. 123 at the moment seems to be the line in the sand. If we can break that, then we may have a push up towards the highs. But we got to watch for all the birds sitting in the tree waiting to chirp from the Bank of Japan Ministry of Finance. All the Japanese bods over there. They're going to be.
Yeah, it looks like if we had a breakdown, this would kind of be a natural place for it to pull back to about 118. I think that's also what it would measure, right?
Yeah, potentially. Yeah.
Okay. So, we have some either ors, same thing in the dollar, although, dollar looks like it's going to make a new high here, held. So we'll see. I think some people are looking for 100 on this. So I'm not sure if that's going to create a new low in euro. I think it will in cable. And maybe Aussie still looks neutral, like it could break out either way. You would think if the dollar was going to have one more push, that maybe it would, instead of breaking out, break down.
Yeah, well, lots of assets looking a bit consolidatory, aren't they? That dollar index chart you just showed there, perfect. Defined highs, defined lows in the range.
Sideways since the beginning of March.
Yeah, so you lean on the levels and look to go with a break, perhaps. If it gets below that blue dotted line you got there, then you got to look for a short, perhaps, on the break, and the same on the top. If it gets above that, what's that, 99, 30, 40-ish? You got to try for a long. But yeah, obviously it depends on what's happening in the other pairs. Dollar yen breaking up, euro dollar breaking down. It could be the kicker, as you say.
I have a technical question. After the close on Friday, I came back and I looked at the S&Ps, and I noticed before the close, everything rallied back. But as you can see on this platform, it's showing it up 46. Did it really close at 44.07 down here? I mean, if it did, it happened after the market closed. I hear there's some type of new order methodology for the commercials to put their trades in after the close, and you had S&Ps at 45.07, down a ton on Friday. When I thought it, huh?
What do you mean? Some sort of like closing market?
Yeah, like 37 handles it dropped. So you don't see that kind of candle. Well, you do in NASDAQ, but anyway, I had a strange. It closed at 45.07. which was, down here.
Let me see where we got a close here.
I think.
Yeah, if I've got a close at 4507.57. So
yeah. And I think it happened. I think it happened. Yeah. Anyway, so I don't know. Just something that, I was surprised when I came back and looked at the close after the way it looked at the close. So I don't know what the story is there, but if you can't count on the market being closed on the close, I know there's always aftermarket stuff, but not 40 handles worth.
No, very strange. It might just be a CFD thing.
Yeah. Okay. Well, metals are trying. This almost looks like on a smaller magnitude, kind of an invasion trade. You have a strong dollar, you have strong metals. You have the market up, you have crude up. Crude, still trying to hold this 100 level. But if I had to pick a couple charts that I had some conviction about, it would be this. And last week I was talking about buying bonds, and they're starting to look good. And this is a real kind of interesting chart on bonds. So everyone was calling that a breakdown. This is a weekly.
Yeah.
So we're on the verge of a false breakdown, and really it could be a falling wedge. So I wouldn't want to be short bonds down here.
No, but you can also think that might be a confirmation move you're getting there of that break. If it does hold that line you've got there, that's a confirmation of the break, and then it's the price is heading lower. But I think you're right in the very short term. There isn't a lot of conviction, intraday.
I'm having a hard time having long-term conviction too.
Yeah, I mean,
not just a short-term for trades, but a lot of things look like coin tosses to me.
Yeah, and we had a lot of inversion talk, last week. Is that really going to follow through? Is it one of these things where all the headline grabbers scream about inversion, but the sensible heads think, okay, well, we've got a bit of market moving, but we're not heading there just yet. You know what I mean? You get all the ones who run around with their pants on fire screaming it's the end of the world. Every little thing, and the sensible heads don't see it just yet. I don't see it just yet.
Okay.
But
I'm
a question.
I would think that if there is going to be rates come back down, that it's good. I think the catalyst could be, risk off. I look at great pattern in play by Blake last week. We're back under this pivot. It looks like it's just flagging here, and there could be another one of these from someone here that could take us back to 44. That could take rates down a little bit. And if it turns into a bear, some technicians could say it could pull all the way back down to the breakout of this wedge. I don't think that would be healthy because it's all the way down to 4,200. So I'm still looking at this day's lows. This was when Powell came out and was super hawk.
Yeah.
And the market fought its way back. So you knew you shouldn't fight the market. And, we had this push up, clean out bears.
You can probably draw a line there now off that top to that secondary high.
Keep
an eye on it. Yeah.
So anything else standing out before Stel, I'm pretty sure you're usually around. So even with metals correcting from your entry in silver still looks good. What are you looking for from here?
I still think we're going higher, but I've put my we have the 200 DMA, which is coming up. Was it 30 something? I'm going to put my stop below there. So still a little bit for that little piece that I bought the other day, right? Yeah. My core long is still there. But I'm going to put my stop. I've already put it. I did put it originally at 24.40. I'm now dropping it just below this 200 DMA. But as I said before, this is not wasn't a big position. It was just something that looked good at the time, and I got in. But
no one cares how big or small your positions are, really. But you know what? The point of entry was really the key.
Well, you have to be patient, right? You remember I was talking about it for days and days.
Yeah, a few weeks.
And it did get a little bit below my entry, 10 cents or so, but still it was good. Good to get lucky sometime like that. But
you're so humble. I'm going to throw up. I'm kidding you, man.
So what do I think about you talked about DXY?
Yeah.
It's a tough one. I think I am in the medium term. I think we're going quite a bit lower, but in the short term, I think the risk is probably for one final blow off top, maybe take out those highs. Recently, if you notice, we've seen so many false breakouts and breakdowns in so many instruments that I think this would be ideal. I think if we break above, if we break above, we go towards 100. I think that will probably be it for this move, and then we go quite a bit lower. But obviously, who knows? I'm just trying to speculate and see.
Yeah, you're gaming it out. We all do that. We all think, we sit here at the screen and we think about potential scenarios based upon our technicals and what we would do if it did that. We're not guaranteeing it's going to do that, but we're mentally preparing ourselves so that we're not doing the analysis on the fly at that time. And instead we're ready to execute.
And having said that, it's a similar story with stocks. I think we should have a proper correction at some point, but in the near term, I still think the path of least resistance is to go higher. So it's a tough one. It's a tough
78.6.
Yes,
didn't quite get there.
Could be.
Someone said that the S&Ps love 88.3. You know who it was? It was Nick. A long time ago. She said S&Ps.
Nick who? Oh, Nick. Yeah.
We don't say her last name. How you doing today, Kman? Are you around?
No. Good morning, America. Good afternoon.
That's a great show.
I'm very around, Dale.
All right. You're a character. So what do you think of our analysis here on yen? What are you hearing? What's the Japanese whale doing before they capture it and turn it into sushi?
I don't know what they are planning to do for the start of the new fiscal year, but what I did see was Kuroda not being in the least worried about the yen level. He's only worried about his yield curve control right now. He repeated it again over the weekend, so he leaves it completely up to the MOF or the Japanese cabinet to do something. In the meantime, the government is putting an extra stimulus plan in place to pay for parts of the higher energy costs. So I think the market is not worried at all about. Or at least right now, not worried about any intervention. So I still have my 123 put dollar yen that I bought for end of April because I thought at the start of the new fiscal year that Bank of Japan may start to do something about the YCC, but Kuroda is just enjoying his sake probably and not doing anything about it. So
how much time do you buy on your options? When do they expire? The 123 puts you're in. When do they expire?
29th of April. That's the day after the Bank of Japan.
Okay.
All right. But as I was saying in the room this morning, I'm actually thinking of selling them out again now that I still have some time value in it, still a little bit below the level. To just to get the rest of my premium back. I'm already deep in the money. I've been trading it around over the Bank of Japan, over the FOMC. Maybe not after the FOMC it was, but over some other events like the end of the fiscal year. So I'm already in the money, but I'm 50-50. So it can go up or down, but it has to move. The thing is, I'm thinking of selling it out just because Kuroda is not worried at all, and that was one of one of the reasons why I put this put on. In the meantime, I've been trading the hedges around, so that's fine. So yeah,
if that was a contingency for the trade, and you believe that contingency is no longer there, then I always say, when in doubt, out.
Yeah,
could always get back in, right?
If I would only have the option on without having hedged anything, I would take it off. 100%. But now I hedged a lot, and then I've been playing around with my hedges, which done absolutely great, because I put it on when it was in high 124s, and then it went all the way down to 121. So I mean, it's doing an absolutely great job. So that's why I sold half of it out, but I'm still running the rest and doing the hedges around, which is nice to play. And for the rest, but one of the reasons dropped. That's what I was going to say. One of the reasons why I put it on dropped. So I think for me the risk is that dollar yen starts to go up again. If it breaks 123.25, we could be quite quickly back to 125.
Yeah. A lot of tough calls on the board. That's the way it looked to me on the weekend. I didn't see anything that was really, so compelling for me. I bet Blake sees things going on.
Yeah. You know what? Good morning, guys. How's
Good morning,
it going?
Blake.
Sorry, I was in the middle of handling just a couple other things, so I didn't catch all the commentary. But I wanted to say, actually things are pretty quiet. But let me ask you guys this, and let me ask you this, Kman, Ryan, why is the euro so under pressure today? Why are we trading down at 110?
Sentiment indicators are absolutely getting trashed.
Yeah.
The more they put sanctions in place, the more and the market is expecting to pressurize euro further. We are going to wrestle in Europe with the long-term effects of these Russian problems, right? Even if they can get gas from Norway, some from the US, it's going to cost them an arm and a leg, right?
Right.
So I think that has to do with it. I think there was a lot of flows going on over the end of the month, and probably Friday, last Friday, and it's just, you have to look at the flows as well, right? I mean, if people sell Friday, we came off more than a big figure from the Thursday high, right?
Right.
That means that there's some flows in there. If you don't have inverse flows, where's the bounce coming from, right? Not from the day traders, because they buy in the morning, sell in the evening, or the opposite.
True.
So I think it's more about the sentiment in the euro right now, and it's a euro move, because if you look at the dollars, as such, haven't moved much, right?
It really is a euro move. I mean, you can actually see the yen pairs to the right here, where you have just the euro yen that's down. You have the guppy, the Aussie yen, the Kiwi yen, Canadian yen. They're all higher.
Yeah. And then,
you have every euro cross down. Euro sterling's moving lower down towards the 618. The euro Aussie is rejoining that downtrend. The euro Kiwi, in a euro consolidation. So.
And there's one interesting one I'm still looking at. Is on the EM side, is the euro makes. Since we've broken through that 2270, it hasn't looked back at all. And now we are on a pretty important support here, in my opinion, around this 2170.75. We are around there, right? It's 2180.85 right now. If that breaks, there might be another leg lower, and I think that's what weighing on the euro dollar. All those euro crosses, right?
Yeah. But we had the Centex index, which is not one that is usually market moving, but it absolutely collapsed today. Yeah. -18 versus -9.2, and the comments, they don't think the ECB is going to ride to the rescue of any economic weakness, and that's a not good news for investors.
Do you really believe that, Ryan? I mean, do you think that the ECB is going to, just kind of let inflation run as hot as it is right now and not do something about it?
I don't believe it. No, I think they may do. I don't think they should do, but I think they may do because they are sticking to their wagon that a lot of this is still temporary, and they're right to a point. But this goes back to what we said before. You can get inflation shocks. We had lumber. Look at lumber and all that sort of stuff shooting up last year.
Yeah,
and energy now. You get these shocks. The problem is how long they last and what it does to the rest of the inflation. How long that stays high. So it's okay saying, an energy shock is fine. Oil could drop to $80 tomorrow. That doesn't mean the shock's over because everything else has been elevated now, and prices go up far quicker than they go down. So where we settle after the potential shocks come out, and if inflation's settling at 3, 4, 5% after we've gone to wherever we're going to in the short term, then they've got a problem because their target's 2% or their mandate's close to or below 2%, and that's what they're waiting for. But I think they've got a bit of a head in the sand syndrome with this. They had their chances to at least show that they could do it earlier, remove the emergency measures quicker. For all the talk about the Fed, at least they're pulling their finger out and now doing something, be it right or wrong. The ECB just still seem to have their heads up their asses and are ignorant of it, and that's probably going to bite them in the arse.
All right. Well,
that was a lot of ass in one sentence, man.
A lot of ass.
Yeah, I know. Seriously, all sorts of ass going on.
Not sure what kind of a show we're running here anymore.
So let's. I was just going to say, if you're a Euro bull and you think that this whole conversation is complete horse crap and a lot of ass, and you're like, the ECB is going to move, they're going to be a little bit more aggressive. This is the place where you need to be buying the euro. In my opinion, this is like you need to own it today as it's around 110 if you believe that the ECB is going to move. And look, from a risk reward perspective, longer term, I mean you're talking since the creation of the euro, really since well, here, let me go over to it.
Do you have to risk 108 on this?
Yeah, you do. You have to risk below 108. I mean, you're talking you're risking 200 pips to and I'm just thinking longer term. Yeah, for those of you that trade options or you want to start nibbling longer term, I mean, you're risking below 108 to make moves up to the teens again. I mean, if you are a dollar bear overall, this is the place where you really want to be buying the euro, somewhere around these levels, in my opinion. And that's not just speaking because I am long euros. I do own some euros at these levels, around these levels, but I'm just saying that if you guys are playing from a longer term point of view, this is the place where you probably want to be long, somewhere between, I don't know, anywhere between 109 and 110. And 110 right now today, obviously gives us that good opportunity as we're at the 4-hour trend line, 78% retracement. This is like a nice pivot area, on the dips below 110, and you're finding buyers down there. That's something that we noted with ForexAnalytix this morning, is that you're going to find buyers down at these levels, and so anyway, that's going to be my opinion there. So how about the S&P? I mean, let me ask you guys this. Just a real quick question. I heard Steve's in here too. Do we see 4,600 first, or do we see 4,400 first? What do you guys think?
Unfortunately, I think we see 4,600 first.
Why, unfortunately?
Because
you're a bear?
Fundamentally, we should be quite a bit lower in stocks, but we're not. I don't have a position.
You are the devil.
I am the devil.
People. You are. Yeah. Unfortunately, don't give me that crap. What do you think, Steve?
About what, mate?
4,600 or 4,400?
Yeah, that is indeed a good question. Now, I'll have to reiterate what we said last week, meaning as long as we've broken out from this corrective formation that we had lower, technically speaking, if I completely ignore anything that has to do with fundamentals, I would have to say, if you showed me this chart and they didn't know what it is, that the path of least resistance is higher. Now, if I take into account the fundamentals and the rapidly shifting environment, I would be super scared being long. right? Super scared. I think that market participants having to do with risk assets and equities remain completely oblivious to the obvious dangers. But we know, and we've seen in the past, that this can take longer for them to start having a more realistic perception than somebody would assume. So, yeah, I would have to say 4,600.
Okay, well, at 4,600, you are not the devil.
Yeah.
Oh no, you are.
Yeah, but for other
Ryan,
reasons.
what do you think?
I'm going to say 46.
Man, you guys all suck. I think we're going to 4,200.
You know what the funniest
tomorrow.
Part is?
Tomorrow.
People know it.
We're going to 4,200 tomorrow. I'm going to skip 4,400. All right, Kman.
The funniest part is that I'm actually short.
What's that?
The funniest part is that I'm actually short. I'm slightly in the money. I've told people on the webinar, but I'm considering, seeing how we stall here, I'm considering perhaps taking that very little profit because I see that we're probably about to shoot higher again, likely. I don't know. I'm going to consider what I'm going to do. Yeah, but I think we might see higher prices short term.
Okay. All right. Well, what do you think, Kman? Do you have an opinion here?
4,700 before the next FOMC and then 4,200.
Wow, look at you guys. All right. Well, no one thinks we're even going to get close to this 200-day moving average, I'm thinking, but it's interesting to hear all of your perspectives.
But I think the stocks have no real reason to go much lower before FOMC really start to take away from the punch bowl.
Okay, so you don't think that all these expectations of rate hikes going high, moving higher, is really going to affect the market at all from here, or risk appetite? I
think the most important will be quantitative tightening because the market is already pricing in the hikes. Look at the 2 years, the 3 years in the dollar rates; they're already pricing in those hikes.
Got it. Okay, well,
that's my 2 cents. That's all.
No, you know what, and it's good. It's good to hear. I mean, everybody seems at this point in time pretty bullish, but me. And I think actually this false breakout from last week is actually going to weigh on prices. Well, let them bid them up this morning. I think you sell them at the open. That's my 2 cents. Now, one last thing I want to talk about really quick while I got you all here. You know, we got crude oil. I think crude oil is holding up pretty well above 100. Where the hell is my crude oil? I just had it here just a second ago. Oh, there it is. Okay, so we have crude oil that's trading above 100 right now. Nice little trend line here. You know, and it's got us really well supported. Notice how we continue to make higher lows, which is, you know, obviously a nice bullish trend. Do you guys think we can sustain above 100, or do you guys think we're going to be trading lower? What do you guys think?
I think it's got a chance of going up. You know, we've got more comments from Germany, perhaps stepping closer to oil gas embargo on Russia. I think that might be the thing that tips it higher if that gets confirmed. And
you know, let's just talk from a risk reward perspective. I mean, if you guys are you know, trading crude like today, I mean, look, your risk is very, very well defined. It's below 98. You know, breaks 98. You know, you're wrong. But you know, your upside could be, you know, back in the teens. So, I mean, from current levels, you know, your risk rewards maybe 1 to 3. I mean, that's not bad. That's not bad if you're trading crude on the long side right now. So I agree with you. I think it can move higher. Stelio, Steve, you guys have any last minute comments here on crude?
No, I'm 100% with you. I've given 2 scenarios about crude since several days ago. One of them is we go lower from here for a lower low. The other is that we might be crafting some kind of a symmetrical triangle, like longer term symmetrical triangle. In both cases, I think the risk reward is tilted to the upside from where we are. So I 100% agree with you. Plus, you know, any surprises we get under current circumstances are more likely to be positive than negative crude. So, you know, you might get some kind of a windfall move in your favor, right?
Windfall profit tax.
Yeah.
Awesome. All right. Well, then there you go. And I think we lost Stelios here, which is fine. But I want to say, hey guys, we have this week you guys remember at the end of the week, this huge Trader Summit event. Whoops, that's not it. Huge Trader Summit event that's coming up. If you guys haven't registered, this is the time to do so. Remember, seating is limited, especially when you go to log in live. If for some reason you can't log in and when we go live because you're trying to catch one of these great speakers, and you can go back and say, oh, like told me so, right? You'll get the recording, but you want to be there live so you can, if you can, so you can be asking questions. So make sure you guys get registered. It's free. Be there. It's gonna be like probably one of the biggest events of the year. I mean, look at the lineup of speakers that we have, and I'm kind of bummed out because I wish we could have Luke Groman on here on this event.
Okay, well, maybe next time.
I know. Well, maybe next time. All right. Well, hey guys.
Somebody's asking for the schedule, Blake. So why don't you browse a little bit lower and show them that there is actually a specific schedule there?
Yeah. First of all, let me grab this link and let me go ahead and put it right here for everybody. And remember, if you get registered, you actually get the recordings, even if you can't be there. So that's the key. So there's the schedule for Friday, Saturday, Sunday. Big, long, great event with so many speakers. So there we go. All right. Dale.
Yep.
Have a great interview with Luke, and hopefully Luke can join us on our next event. That'd be awesome.
Okay.
All right.
All right. So Luke, welcome back to F.A.C.E, buddy.
Thanks for having me.
Okay. So why don't I there you are. Okay, we're gonna do a talking heads interview here today, Luke. Perfect. All right. So, Luke, I'm lost in the middle of the forest, and you heard our banter before before you came on. We're looking at all these different trees while we're lost in the forest. I bumped my head on a tree that said Fed. And then I stumbled on a tree that said Ukraine. And then I stumbled on a tree that said agricultural commodities, especially grains. And it made me think we're going to have to learn to eat bark. And it's not a joke, like Ewell Gibbons did. All right. You're probably too young to remember Ewell Gibbons. He was a naturalist. So if you would please take us to a nice hilltop view of the forest, so that we could take a look at and hear from you what the forest is either whispering or, what it's screaming at you right now. Because you and I haven't talked for a while, and there have been some, pretty dramatic things happening in the world.
Yeah, to me, the thing that's probably screaming the most is, I guess, twofold. The first is it looks like we're heading toward a recession, and I think possibly some sort of economic crisis led out of Europe. A recession, let's say, out of Europe, as they're basically committing hara-kiri with the energy sanctions. If they try to do what they're trying to do in terms of restricting gas usage, they're going to have a pretty severe recession, and that then ties into the second point, which is sovereign debt. To me, is still the big issue. Western sovereign debt, and specifically you can't have a recession with U.S. and European sovereign debt as high as it is. One of two things will happen. I've spent most of my time talking about it on the U.S. side, but it's going to force the Fed and the U.S. government into a choice. Either they have to choose for the U.S. They either have to, because tax receipts are running at about 100% of what I call true treasury spending, right? So, or true interest expense, excuse me. It's treasury spending plus entitlements is about 100% of tax receipts, and tax receipts are at all-time highs, inflated by 12% nominal GDP last year, which is of course inflated by 8% CPI. If you have a recession, tax receipts are going to fall. The entitlement obligations, the treasury spending obligations are not. You could layer defense on top of that. If you throw defense on top of those two things, excuse me, it's 120% of receipts. And in a recession, receipts fall. And so then you just say, okay, in the case of the 120% Treasury spending entitlements defense, which does the United States cut in a recession? By a lot, to try to avoid not having the money to pay one of those three things. And the answer is either they have to cut or the Fed has to print. And to me, it's strange credulity in an election year that they're going to cut entitlement. Strange credulity to think that they're going to default on treasuries. It's strange credulity to think in the current tensions geopolitically that they're going to cut defense. So they're going to have to print. And I think, to me, that is maybe the message of gold and the metals versus is I think the reason gold has stopped reacting to rising nominal rates, to rising real rates, is I think gold's looking through the valley and just saying, the people that are buying gold are saying, I don't care. Maybe we get a brief recession. Maybe it even reduces demand for these commodities for a bit. But the more sensitive dynamic is this Western sovereign debt issue, and they're going to have to print so much money to avoid defaulting. I don't care. A recession is hugely bullish gold, and I think that's probably what we're seeing in some of these commodities as well.
So it's only the short-term guys that care if they pay $1,900 or $1,600, which I think is a possibility if we get that recession. I mean, contrarian wise, Luke, these commodity markets are overheated. It's the most bullish I've seen people in commodities since I've been in the business, maybe since the 70s. Okay, so I think it's that they could take a breather. And it's interesting when you talk about sovereign debt crisis, people really don't even know what it means. You're talking about the treasury market, and do you think that we could get maybe a bear market rally in treasuries in this period? They're also one of the most hated markets out there. What do you think?
I think you could see the action that you just described. I think gold will continue to kind of stand on its own. I mean, you could have a little bit of a downdraft, but I don't know that it'd be as big as, simply because of it is sort of the thing that wins either way. Whether they print without the recession, whether they have the recession or forced to print. Because again, if you have a recession, you're going to have credit risk in sovereign debt. It's a really good environment for gold, not for commodities. Right. I totally agree. But I think you could have a bit of a counter rally or counter trend move in treasury bonds. I would agree with that from a trading perspective, particularly when you look at some of the technicals you guys were showing earlier.
Well, could risk off be the catalyst? Because last time during the sell-off in equities, bonds and equities both went down together. Before gold turned, it was going down. It's like only cash was working at that time. So do you think that looking at the forests that there's a possibility that yields could drop for a while, and that the sovereign debt crisis could be delayed because of that?
I think it is. I think it could look something like what we saw in March 2020, right? Where I don't know that it would be that pronounced, the drop in yields, but if the Fed stands back and does nothing, again, I'm going to center in on the U.S. That's where we spend most of our time. If the Fed stands back and does nothing and forces the U.S. government to cut deficits by, 8% of GDP, then you're going to have GDP drop 8%. And by way of comparison, it dropped 7 or 8% in the COVID crisis. And so I think you could see in extremis similar type of action where treasury yields fall at first, dollar rallies, and then stock market crashes, and then all of a sudden 10 days into the 12 days into the crash, treasuries start crashing right alongside. And I think that's, to me, the spot where the Fed comes in and does what they did last time, which was, hey, we're going to do $600 billion a week in QE to stop this. And so it's a time for a trader. I think one has to be very mindful of the timing and the succession of all these events.
Okay. Do you think they go with 50? Do you think they go with 50, half a point in May and June? Will they be able to get that far And will they ever be able to get to, balancing their trade account, QT, quantitative tightening?
I don't think they can do the 50, and I don't think they'll ever unload all those bonds. I think they're closer to buying more bonds than they are to selling bonds, to tell you the truth. And again, it goes back to how little I'm seeing in market discussions about, look, the U.S. has a balance of payments problem. They have a fiscal crisis. There is no one to buy enough of these bonds. You're running $2 trillion deficits, and you're talking about a dollar that's going to make the rest of the world trading at a level where the rest of the world are marginal sellers. So the Treasury is selling. The Fed, in theory, is going to sell. Foreigners are going to sell with the dollar where it is. Banks maybe can buy some, but they're limited in scope with some of the banking regulations. So you say,
more supply, less demand.
Who's buying? And so to your point, you can get demand if you scare enough risk assets out of risk assets into treasuries. But the problem with that is we've allowed debt deficits and the importance of risk assets to tax receipts to get so far stretched that it's, as I was just describing in March 2020, risk assets are critical to driving tax receipts through the consumption link. And so if you can move risk assets sort of over to buy treasuries for a bit, but if you do too much, then you're going to send the economy into a recession if risk assets fall too much. And in a recession, your deficits are going to blow out. Your in treasury supply is going to rise, not fall. And so you actually make the problem worse if you do that. So you actually have, when you talk about the narrowing gaps, the Fed is in almost one of these narrowing channels as well, where the dollar gets too strong, the dollar gets too weak, and that it used to be a big channel, and it's getting smaller and smaller and smaller.
Compressing
their operating room.
Okay, so you talk about the dollar, and to me it looked like there was a chance that it may have turned. There could be another push to new highs. What do you think is really going to be the catalyst? Is it could be interest rate differentials? Could what we did by weaponizing the SWIFT system motivate people to speed up their de-dollarization? There was some talk that Saudis are going to take yuan for oil. Do you think there's a chance that the Saudis may begin to price crude oil in a different currency? That would be the end of the petrodollar.
Yeah, I think they're already doing so on a modest basis. I think they're going to get more aggressive with it, particularly after what we did with FX reserve sanctions. I hear credible rumblings that they found that our sanctioning of Russian central bank reserves terrifying, and rightfully so. And so I think in the long run, in the intermediate term to long run, the fundamental outlook for the dollar is extremely weak, by virtue of, in no small part, based on what you described, which is there's a de-dollarization of global FX reserves happening. There is, as you can price oil and commodities in other currencies, there's less need to hold FX reserves with less in dollar terms, excuse me. Yeah. And you're also seeing the U.S. pushing people to that decision with the sanctions on central bank reserves. Treasuries are suddenly risky for sovereigns to hold in FX reserves.
Well, they're saying. Go ahead.
Yeah, I was going to say I think there's a fundamental weaker demand structurally for dollar reserve assets at the reserve level going forward. Now, in the short run, I think a lot of it depends on events. I think tactically, I'm actually bullish the dollar. I think it could get a little stronger before something really breaks. But when I look at what Europe is doing, obviously the biggest components to the DXY are the euro and the yen, and I look at the Eurozone, and I don't think people fully appreciate the economic catastrophe that's brewing over there. You can't do to energy costs and supplies what they're doing and not have a severe drop in GDP. And you can't have a severe drop in GDP with debt where it is. That's going to bring in the euro. The ECB is going to have to print into an inflation spike to prevent the default on sovereign debt there. And then the U.S. is going to follow the same playbook on, shortly thereafter, in my view.
So if the dollar is peaking, Luke, and the way you describe Europe, the euro doesn't sound like a real attractive candidate for a dollar hedge. What fiat do you like? Commodity producing countries?
It's
I don't like any of them. It's okay.
I tactically I'd like the dollar, but I don't like I'd probably look at the Swiss franc. Is probably where I put money. I mean, they're printing francs and buying U.S. corporations. That's not a bad gig. Beyond that, I mean, I still think too the you can't really trade it as a problem, but the yuan I think has been quietly over the last 6 to 9 months rising against the dollar, despite the dollar tightening rate or the Fed tightening rates and the PBOC loosening policy. And that's, I think, whispering a very important message to the market that the market, still tends to ignore because it's China, it's a closed capital account, they're communists, they're emerging market. And the market's telling you something might be changing there. Chinese government bonds have outperformed U.S. Treasury bonds on a 2-year, 3-year, and 10-year basis. Most people, myself included, as of a few weeks ago, were shocked to learn that. The markets are speaking. Nobody's listening because they're just saying, "Oh, it's China and they're bad, China bad," and that's it. And things need to be painted sometimes a little bit more a shade of gray. But
so maybe China's ahead of what the Fed's going to have to do. As soon as the real estate market caved, they did switch to more easier stimulative policy.
Yeah, I think
Evergrande.
I think that's probably a big part of it, right? Is the perception that there is more GDP growth there, right? That they're taking steps to support GDP growth and the support of the currency. I also think that what they're doing with yuan-denominated commodities, as we were talking about earlier with the Saudis, completely changes the game for how we look and think about China and the yuan as a currency. All of a sudden, you start having offshore yuan balances that can be recycled back into Chinese assets. You talk about China as being a nation that can print their own currency for oil, gas, and other commodities. And when you look at China's balance of payments, that's the biggest outflow of dollars historically. So every 10% of commodities that China can shift into yuan increases their dollar liquidity that year by $150 billion with commodities at current prices. And that's in addition to the $30 billion a year we're currently sending, $30 billion a month we're currently sending China in dollar liquidity via our trade deficit. So there is, and I think in addition to the stronger growth, there's this angle that that the yuan is becoming less and less susceptible to the traditional emerging market dollar liquidity balance of payments crisis that a lot of people that were shorting yuan over a few years ago.
Okay, so we could take a look at the yuan and see what it's doing, because there was a pretty good move, and so maybe that's it almost looked like the yuan was getting ready to devalue, and I look at this long-term chart here. Here's your daily, here's your weekly. Doesn't it look like there's some type of bottom developing there, Luke, in US dollar yuan?
It does technically. It does look like it's, and again, I think it's underappreciated, the dynamic that this yuan oil in particular, but yuan commodities gives them in terms of flexibility. Because if you can, as a trader, you think about it. If you have flexibility in which currency you buy your commodities in, and the commodities are your cash outflow, and you can buy them in yuan or in dollars, your choice, then suddenly, based on the blend of commodities, the blend of currencies in which you're importing your commodities, you can start to manage your currency relative to dollars, right? You can start to manage the yuan dollar cross rate based on the blend which you are bringing in commodities, the currency in which you're bringing in commodities. And so that is a lever that is completely new for any emerging market, any other country in the world. Historically, it's been, hey, the yuan either needs to slow economic growth or they need to, sell dollars to defend the yuan. if you look at their FX reserves levels next to that yuan dollar chart, what's really interesting to me is that it's not moving. It's not growing really, but it's also not shrinking. So they're managing to keep the yuan stable while FX reserves aren't moving, which is sort of exactly my case all along on why I think yuan energy, yuan commodities is so powerful. Is it allows them to manage the value of the yuan using commodity markets relative to the dollar, without having to buy and sell dollar bonds, which then flips back to our point earlier that fundamentally I think there's been a sea change in foreign demand for treasuries and for dollars broadly that I think is heading one way in the long run.
Well, this guy doesn't want dollars anymore. There's your U.S. dollar ruble, right, Luke? So he wants euros. He wants anything but the dollar. He'll take anything. Does this say that Russia really didn't get hurt that much by the sanctions? The fact that we've almost recovered. Some people say the price structure that we're getting since the invasion, the prices aren't. You can't count on them. But to me, it looks like they've recovered most of their losses, from 160 back to 96 in 2 weeks, is a recovery in the ruble.
Yeah, and I didn't think he'd invade. He did. He surprised me. I think he surprised a lot of people. But
he probably surprised himself.
After he did that, I was pretty vocal. I said, "Look, I think that Russia has way more leverage than people think, and that ultimately there's going to be a marking to market of relative power levels between the West and between Russia." And I think we're watching in real time as that is taking place. And the basis for my view was, I actually said in 3 or 4 different interviews, I said, listen, I think there's going to be a tiering of their responses. I think tier 1's going to be, okay, fine, we're only taking rubles for our energy. And then I think tier 2 is, okay, then we'll only take gold for our energy. And he has sort of done both of those things in sort of a hybrid manner. But I sort of laugh at, I've been seeing some of the U.S. officials over the weekend say, well, the improvement in the ruble is not really a free market. Right. And it's like, yeah, great. Now do treasury bonds. Now do the Fed's balance sheet. Now do, anything, a lot of different Western financial markets that aren't nearly as free as they used to be. I think they were surprised by his actions and how effective they've been. And to me, what that chart tells me is that if I look at the petrodollar, the real value is in the petro, not the dollar. And I think that chart is sort of a great big statement that the real value is energy, and it's not the dollar. You can print dollars, you can't print. You can print dollars, you can't print energy.
So it's their reserves and capacity for putting out such a major proportion of global oil. It was the cause of this, besides the fact that they tried to shut down the central bank. That natural forces, someone was buying the ruble, and the central bank was kind of handcuffed, wasn't it? Who do you think was on the other side of this trade? Wasn't the Fed?
No, it wasn't the Fed. In terms of the weakness of it's
the recovery.
The recovery. Well, they just came out with their reserves the other day. With the reserves the other day, they did burn 30 billion or so before they got locked down. But again, I think that's in the green candle. That's not in the red candle. I think the other side of it is probably the Indians. I think it's probably people buying energy, saying,
China.
China. If all you got to do is buy the ruble and you get a $30 per barrel discount, and then by the way, with China's refining capabilities, you could turn around, refine it, and sell off the refined products in the region in dollars. Like, why not? It's literally, we're handing money of these sanctions. We've changed the reference point to oil, right? As all of a sudden, it's all about the dollar. It's all about the dollar. Well, this shows us it's not all about the dollar. It's all about oil. It's all about gas. And so as long as they have China and India, these massive buyers of energy, then discount it properly, they'll buy it, and a couple of them, can if they can use it and benefit their economy, or they can refine it and sell it off at the full international price, and it's free money.
Do you see an end game to this conflict in Ukraine?
I think, to me, the end game all along, from a big picture perspective, I think on his point has been that this would trigger a financial crisis in the West. That the West, this is basically a balance sheet contest. In other words,
interesting.
He can, he had to have known that we were going to sanction him. I think the central bank sanctions were maybe a bit of a surprise, but that chart shows that they've been able to parry that blow pretty successfully. I think it was effectively, hey, if they want to sanction me, they're going to have to shut down their economies put their economies into a recession. And if they put their economies in a recession, then they're going to have a sovereign debt problem. And when they have a sovereign debt problem, that is likely to be dealt with by money printing. And so I think,
which makes all of his assets in the ground, above the ground, worth more.
And so I think that has been a part of the calculus. As far as the geopolitical end game, I don't have a strong feeling one way or another. I mean, he's been pretty clear for 15 years that Ukraine is not to be a member of NATO. And so I think some of it was just, hey, he felt like it had to happen here and now. And if you gotta, he's on the record saying if there's going to be a fight, you're better off picking the ground, picking the territory for the fight. So maybe it's just, as simple as that. But I do think there's been this understanding of my balance sheet's better than their balance sheet, and I've got energy and they got fiat. So let's go.
Okay. And a real interesting thing I read in your writings, I want to make viewers and attendees, aware of your stuff. And, a lot of people have said to me in interviews over the years, Luke, that they learned the most from their mistakes. And I was reading, you were talking about how you bought a house at the top of the market in 2008, and you were the only person bringing in income. And it was that event that led to you wanting to investigate and really understand how mechanically and esoterically and in every way the economy works and how it isn't working. And did it launch like a new career for you when you got involved in this?
Yeah, I mean, I was able to see it did. I think really for me, the 2008 timeframe forced me to start looking into, okay, how do things actually work? And what I found was pretty horrifying. And so it's been a very big driver to just.
Where did you start when you wanted to find out and you wanted to learn? Where did you start?
It was interesting because it was really a process, because I was working at a brokerage firm and I quite frankly saw what was happening. I mean, late 07, I went to 100% cash in October of 07 because I thought that there was a significant chance the system was going to collapse, the banking system, based on what I'd seen. And so I was, but it was one of those things where even if you're ready for it, it's like, holy cow, like I was right. It might. And then I think the process of, hey, they're just going to print money. Hey, how they'll change the rules on the fly. And so it was a process, right? When they started QE, I think I did what a lot of people did, which was go buy a book about Weimar Germany because we're going to have hyperinflation. And I read that and I say, okay, there are some things that are similar, but there's a lot of really important things that are different. So it's not the same as that, but it's directionally more like that than the way things used to be. And so it's really been just sort of this, self-taught trial and error observational path over 15 years now. That is, and it goes on every day in terms of learning, because there's so many things happening that are so. I mean, if I would have sat down and described to you financial markets in 2006, 2005, and I said, here's what it's going to look like in 2022. You'd have thrown me out of your office. This guy's crazy. Don't ever let him come back in. And yet this is our operating environment. So it's just, I think the key is just this constant strive for trying to understand what's happening, trying to learn what might happen next. And I think that really all kicked off in 08.
All right. Well, I've seen some of the testimonials by your readers, Luke, and you definitely add clarity to a lot of people's the way they look at things now, and you do great work. I believe that you're launching a new or different product at FFTT.
We've got a mass market product that we've had for about 4 years now. It's been a very successful product. It's something we do a launch on once or twice a year. Just to try to bring some new people into the fold. And so we just finished that yesterday at midnight. Yeah, it's called Tree Rings. It's a 10 most interesting things report. Ends up being about a 20-page report most weeks. And it's just things that I've read that I thought were really interesting and a brief synopsis on what I thought was interesting about them. And that way that usually looks is it's interesting because it either fits with something I've been seeing or talking about, or interesting because it doesn't fit. If I'm tactically bullish on the dollar and something shows up that, wow, that's actually really tactically bearish, that's interesting to me, or vice versa. And across different markets and with a geopolitical blend, commodity blend, et cetera, there's a lot of different things we touch on, but that's, I think it's a big reason why it's been as popular is it's just sort of, lots of different areas and willing to go either way, depending on what we're seeing.
Well, thanks for giving us a view of the forest, buddy.
Absolutely.
Today, and only you can prevent forest fires, or should I say, only the Fed can prevent forest fires.
Yeah, they're going to need a lot of water.
All right. Well, you had a lot of fun with you, Luke, today, and really appreciate you sharing your views. And maybe this is your tagline on for the new service: "Don't wait to buy gold. Buy gold and wait."
That's probably I'd point everybody to that Ruble chart, right? It's like, well, I'll buy. Yeah. Things change very fast, both up and down. So yeah. I think that's important.
All right, everyone. All right. Luke Roman, and you can follow Luke on Twitter at Luke Roman, and definitely check out his new letter, Tree Rings, where you actually, Luke goes out with a saw and cuts down the trees so he could see how many rings are in there to tell its readers about. So, Luke, good hunting, buddy. I appreciate it.
Thanks for having me on. It was great talking to you again, Dale. All right, take care.
Have a great spring.
You too.
That's a wrap, everyone. I hope you guys enjoyed it. And you could join the team in about 13 minutes on the Morning Edge, and that's going to be a wrap. You like it? Like it, Paul? Okay. All right. Glad you enjoyed, everyone. Don't forget to sign up for it's going to be a great conference. Don't forget to sign up for a subscription. Don't forget to sign up for the Trader Funding Program. So lots of options for you to expand and get better and grow. Did you? Okay, Hugo. Enjoy. And remember, don't just count your pips, count your blessings. Adios.